Welcome, tax machines, to this lecture on double tax agreements. Double tax agreements are also called treaties. Okay, so before I climb into all of this, this section you'll see I'm not going to go through every single page and every single example with you guys in this lecture. You are encouraged and welcome, obviously, to do so when you are studying and when you're working through it yourself to work through all of them. Understand of a double tax agreement before we start talking about what they are and how they work. In an exam situation, most of the time, a double tax agreement, understand what happens is, let me actually just explain this. We have an income tax in South Africa, or tax acts in South Africa that tells us what to do. And that's what you've been studying so far, what you'll be studying for the rest of the year. But then sometimes the country, the government, will enter into an agreement with another country to say, okay, let's say we are working with England and a person from South Africa goes to England. The double tax agreement will then say, how is that person getting taxed? Is he getting taxed in South Africa or in England? And this might be different from what our Income Tax Act, what you are studying, it might be different from what that is saying. So, in other words, the double tax agreement overrides or overrules what the Income Tax Act says. Now, in an exam situation, we will always assume that there's no double tax agreement until they tell us that there is one. And that is very seldom. In the law, since this has been really become examinable, it's usually been 2, 3, 4 marks maybe. So it's not the end of the world, I would say to you. But obviously they can ask however and whatever they want. You just need to be able to read, interpret, and apply the double tax agreements. Please guys, these ones that we're looking at here, don't go and study them, because they can in an exam give you an extract from one of these, but they've changed it just to see if you can read it. So don't memorize this, just gain the skill or learn the skill how to read this. Okay, so I'm going to point out a couple of things to you which I would recommend that you just take into account and consider, and we'll take it from there. So I'll start with one or two of the first ones and then we'll go from there. Okay, so the only ones prescribed by SACA, the double tax agreements, are the double tax agreement between the government of the Republic of South Africa, so remember if they refer to the Republic, it's South Africa, and the government of the United Kingdom of Great Britain and Northern Ireland, and the government of the Republic of Mauritius. These you can also find in your SACA student handbook. Right, from your syllabus requirements, from your SACA ITC exam pronouncements, it tells you that you need to look at these articles, they are examined, and you'll see we'll cover most of those in here. Right, so you'll see that there's an index, guys, given to you in the double tax agreement, just so you're aware of what everything is included in here, and you can find it if they do refer you to that. Alright, but let's talk about residence first of all. So again, remember my plan and my goal behind this, and your goal, is just to see how I'm reading it, and so you can replicate those skills. I don't want you to memorize it. Okay, so before I start talking, you will see that they refer to contracting state or just state in this. The contracting state is the government, the country. So if this is between South Africa and the UK, then the contracting states will be SA plus the UK. Right, so that's what they refer to there. Now, you will see them talking about contracting state and the other contracting state. So you just need to read it correctly from that. Contracting state will be the one, and other contracting state will be the other. Okay, so I'm going to show you as we get to it. Article 4 doesn't really have a lot of that in which I'm talking about, but you'll see it in a bit. So, for the purpose of this convention is this agreement, the term resident of a contracting state means any person who under the laws of that state, right, so under the laws of that state, is liable to tax therein by reason of that person's domicile, residence, place of management, place of incorporation, or any other criterion of a similar nature, and also includes that state and any political subdivision or local authority thereof. So what are they saying here? They say, if we talk about a resident of a contracting state in this document, that refers to a person who is liable to tax because of their residence. So They're saying, if we're talking about a resident, South Africa, what is your residency rules? Ordinary resident, physical presence test. If it complies with that, that's that. Okay, but now, that helps where a person is a resident of only one country. So, let's, just for now, remember guys, you don't know what the rules of other countries are and we don't study them at all. So it's not the same as South Africa. But for now, let's just assume South Africa and the UK have exactly the same rules with residency, where they say it's a place you ordinary resident, the place you call your real home, the place you return to from your wanderings. So a person from South Africa was born here, he turns 18, he goes to England for 2 years, or for a year as a gap year, and then comes back. Now during that gap year, where is the person a resident in South Africa? Would they be a resident in England if they had the same rules? No. So this paragraph would just say South Africa is the resident. But now, it might be that the rules are different. So we have our residency rules, but it might be that England says, if you come to England, the first moment you put your foot in England, you consider the resident. Let's just assume that. So what will be the problem practically then? Practically, it will be then that South Africa is saying, you are a resident for us, and England is also saying, you're a resident for us. So if this double tax agreement then says the person must be taxed where he's a resident, who is going to tax him? Are both going to tax him? That's the whole reason why we have a double tax agreement, is to stop that from happening. So this next paragraph tells us, where by reasons of the provisions of subparagraph 1 of this article, an individual is a resident of both contracting states, then that individual status shall be determined with the following rules. So they're saying, if your tax laws say you're now a resident in both places, let's see, this double tax agreement will tell you where you should be. Okay, so A, the individual shall be deemed to be a resident solely of the contracting state in which a permanent home is available to the individual. So they say, okay, do you have a home in South Africa but not one in England? South Africa is where you're a resident. But what if you have two homes, one in South Africa and one in England? If a permanent home is available to the individual in both states, the individual shall be deemed to be a resident solely of the state with which the individual's personal and economic relations are closer. They call it the center of vital interest. So they say, okay, you have a house in England, you have a house in South Africa. Let's look at your personal economic situation. Where's your family? Where do you work? Right, where's your interest? That is the place that will then be your home or your residency. Alright, but what if you have family in South Africa and in England? So, if the sole residence cannot be determined under the provisions of paragraph A, so we can't use that rule, we still don't know, the individual shall be deemed to be a resident solely of the state in which he has an habitual abode. Habitual, habit, abode, place of stay. So the place you stay on a regular, out of habit, where do you stay? So the place you go and stay the most. That is where you'll be a resident. But what if you stay exactly 50% of the year in one country and exactly 50% of the other year in another country, and none of the other requirements we've seen so far have been met? So your family is also 50-50. Right. If the individual has a habitual abode in both contracting states, or in neither of them. Oh, so what if you don't have a home in either? The individual shall be deemed to be a resident solely of the state in which he is a national. So where do you have a passport? South Africa. You're South African. But what if you have a South African and a British passport, and you don't stay anywhere habitually, and you don't have family? D. If the individual is a national of both contracting states, or of neither of them, the competent authorities of the contracting state shall settle the question by mutual agreement. So they say, right, if all of these things have been met, we still don't know, the two countries will decide between them where you are. Okay, so I just want to quickly show you as an example. Samantha is 35 years old and a very successful stockbroker. She was born in South Africa but moved to England when she turned 26. She left behind a home in Bryanston. The home is fully furnished. Samantha uses it extensively throughout the year. Samantha travels extensively between the United Kingdom and South Africa. She spends roughly half a year in each country. She owns a house in the United Kingdom where she lives with a boyfriend of 9 years. The court system of the United Kingdom has ruled that Samantha is considered ordinary resident in terms of the laws pertaining to the United Kingdom. It should be further noted that in the 5 preceding years, she spent a total of 950 days in South Africa. She spent more than 91 in each of the preceding days, and is expected she will be in South Africa for more than 91 days in the current year. Briefly discuss the factors that must be considered when determining if the person is a resident of South Africa. Ignore any double tax agreements. So this is just now a bit of revision for you for theory. How do you know if a person is a resident? You first see if they are ordinary resident, and then you look at the physical presence test. Ordinary resident, Cohen and Cattell cases, the place you will return to from your wanderings, the place that you call your real home. So she has a house in South Africa, she spends time here, And we are basically saying that's a factor. The fact that she has a partner in the UK must also be considered. Right, and then you'll see the rest of this is just a discussion. And we're not making a conclusion, they just said what would be considered. Right, so this is all just theory, this is not double tax agreement, this is what you know. Then B, assuming that she is a resident of South Africa and the United Kingdom, because remember the United Kingdom here said she is considered a resident there. So now we're saying she's in South Africa and in the United Kingdom. Where will she be a resident in terms of the double tax agreement? Okay, where will she be a resident? So let's go look here. First up, A says the place that she will be a resident is where she should be a resident. But now it's the UK plus South Africa, so this doesn't apply. Then we go and look here. The place where a permanent home is available. She has one in South Africa and in the UK, all right? But the place where personal and economic relations are closer. Now let's look at Samantha. What happened to her? She is a stockbroker. She left to go to South Africa, and she owns a house in the UK where she lives with a boyfriend of 9 years. The courts will probably decide that because her personal situation shows you that her partner is in the UK, she will be a resident of the UK. Right, income from immovable property, guys. You can work through that one. I want to get to a little bit more challenging one. And let's look at Article 10, dividends. All right. So now I want you to see how to read it when you see a lot of these contracting state and other states here. Dividends paid by a company which is a resident of a contracting state. Right, so I would say when you see contracting state, make that number 1 to a resident of the other contracting state. So when you see other contracting state, that is number 2. Right, so now I want you to keep going at 1 and 2, 1 and 2. Because in the end, you can try and make number 1 South Africa, number 2 the UK, or number 1 the UK, number 2 South Africa. This is how you focus which one they're talking about, number 1 or number 2. Okay, so I'm going to start it from scratch just to show you. So, dividends paid by a company which is a resident of a contracting state to a resident of the other contracting state may be taxed in that other state. Okay, so let's just talk about that. So, I'm going to change the name so you'll see. So, let's make number 1 South Africa and number 2 the UK. Now, I'm going to read it with those words. Dividends paid by a company which is a resident of South Africa to a resident of the UK may be taxed in the UK. Can you see how much easier it is then? So they say, if a company in South Africa, so let's say Tiger Brand South Africa, pays a dividend to a person in the UK, then the person, that individual, must be taxed in the UK, so not in South Africa. So that is the income tax side from the person receiving it. But we also have a dividends tax side. Right, so number 2. However, such dividends may also be taxed in the contracting state of which the company paying the dividends is a resident and according to the laws of that state. So still number 1, that state is not other state. But if the beneficial owner of the dividends is a resident of the other contracting state, the tax charge shall not exceed. So number 2, they're talking about dividends tax. Dividends tax is payable by the company paying the dividends. So they say, however, so let's make number 1 South Africa again and number 2 the UK. However, such dividends may also be taxed in South Africa, of which the company paying the dividends is a resident, and then according to the laws of South Africa. So they say, if a South African company pays it, it may be taxed in South Africa. But if the beneficial owner, this is the owner of the shares, so the shareholder of the dividends, is a resident of the UK, that tax charge shall not exceed. So they say, if a South African company pays a dividend to someone else, there is South African tax payable. But if that person is a shareholder in another country, that dividends tax cannot exceed 5% of the gross amount of the dividends if the beneficial owner is a company which holds at least 10% of the capital. So they say the dividends tax is only 5% if the company and the shareholder is a company which has 10% or more of the shares. It can be 15% of the gross amount of the dividends in the case of a qualifying dividends paid by a property investment company. All right, so this is not really as valuable for us. 10% of the gross amount in all other cases. Right, that is the most important there. So, X Limited is a company as a resident of Great Britain. Ricky is a resident of South Africa. Ricky owns less than 10 shares, less than 10% in X Limited. During the year, Ricky received a dividend of 100,000. Indicate whether the 100,000 is taxable in South Africa, ignore any double tax agreement that exists. Okay, so this is a foreign dividend. Ricky is a South African resident, so it'll be included in his gross income and it'll be exempt. So this is just the normal, this is just revision of what you've studied. Now, indicate whether the 100,000 is taxable in South Africa, taking into account the DTA. So remember, X Limited is a company that is a resident of Great Britain, and Ricky is a resident of South Africa. So if I go back here, where we called it number 1, number 2, now you can see they're just asking it the other way around. So number 1 is now the UK, number 2 is South Africa. Number 1 is now the UK, number 2 is South Africa. So dividends paid by a company which is a resident of the UK to a resident of South Africa may be taxed in South Africa. So what are we saying there? That these dividends will be taxed in South Africa, so it will be included in his gross income. That's it. The next one talks about the dividends tax payable, guys, and you can work through that. And the rest of the double tax agreement. So all I wanted you to see is, again, if you look at Article 14, just to quickly show you, they'll talk about a resident of a contracting state as number 1 to the other contracting state, number 2. And you'll continue doing that, 1 and 2, 1 and 2. So contracting state, other contracting state. And you can then switch it around and change it like you want. Like I said, guys, this document I've given you here is extremely extensive. There's not really anything like that in any textbooks or anything that you'll see. So I try to give you a lot of examples here. The reality is, usually they just give you a little extract like that paragraph over there, and they tell you to apply it to a question. So as long as you can read it and interpret it, you are gold. Great, thank you very much, guys, and best of luck. Let me know if there's anything.